Welcome to Market Plus by Orestes Capital, your daily briefing on the key market moves, macro developments, sector trends, and investment themes shaping the day. Today is Monday, May 18th, 2026. We're Elena and Marcus.
Welcome to today's institutional data review. As you calibrate your models for the week ahead, well, the data from today's session demands immediate attention.
Right. Imagine watching oil spike past 108 a barrel while copper plummets nearly 3% in the exact same session. That is not a normal market.
Correct. That is a textbook stagflationary footprint staring us in the face.
So today we are breaking down why this divergence, combined with a severe breakout in long-end yields, requires a fundamental reassessment of portfolio risk.
We have three essential takeaways for the macro-focused investor. Let us review the big three. First, the stark divergence between the geopolitical risk premium and macro reality. WTI crude settled at $108.66 on U.S.-Iran volatility.
Which, stands in severe contrast to copper plunging 2.75% following severe Chinese economic data misses.
Indeed. Second, the rates breakout. The 30-year Treasury yield climbed to 5.126%, with real yields holding highly restrictive territory at 2.130%.
Signaling a late-cycle tightening regime.
Right. And third, positioning extremes. Proprietary modeling shows a 99th percentile reading on the risk appetite indicator.
While simultaneously, gross leverage across major prime books hit a 5-year high of 318.0%.
Leaving markets structurally vulnerable to exogenous shocks. Moving to the desk data. The dominant macro move today centered on severe intraday whipsaws driven by U.S.-Iran headlines.
The volatility was continuous, requiring constant recalibration across trading desks.
By 8:13 a.m. Eastern, Iranian media reported the U.S. had offered an interim oil sanctions waiver. The market mechanics here were immediate.
Right. This headline caused Brent crude to briefly reverse its gains, the 2-year yield to fall, and equities to pare their pre-market losses as algorithms priced in an immediate de-escalation.
However, the narrative shifted sharply by the afternoon. Contradictory social media posts from former President Trump initially suggested he would withhold a scheduled Tuesday attack,
dropping WTI by $1 to $2 post-settlement.
Yet barely 40 minutes later, a subsequent post warned the U.S. remains prepared to attack on a moment's notice.
We must view these political and geopolitical updates purely as market catalysts. The market reaction appears appropriately calibrated, neither fully pricing a deal nor fully pricing an escalation.
Understood. But we must connect the commodity pricing action to the broader macroeconomic data. The surge in oil, with WTI finishing up 3.1% intraday, occurred against a backdrop of dramatic overnight data out of China.
Yes, institutional research highlights that Chinese retail sales, fixed asset investment, and industrial production missed expectations by historically wide margins. So, if we strip away the headline noise, the divergence between oil rallying past 108 pounds and copper shedding nearly 3% looks like a textbook stagflationary footprint. Are we misinterpreting a supply shock as a growth cycle?
Correct. The commodities market is aggressively pricing a risk premium for Strait of Hormuz disruptions, not global demand.
To your point on misinterpretation, a genuine growth-driven commodity rally requires both energy and industrial metals to move in tandem, right? Copper is often viewed as the definitive barometer for global economic health.
Indeed. Its sharp decline today signals deep demand skepticism, an assessment further reinforced by silver moving marginally lower on industrial demand concerns.
So when you see oil surge but industrial metals crater, the market is telling you that supply constraints, not robust consumption, are driving the energy tape.
The equity market rotation confirms this defensive, inflation-focused posture. We saw staples up 1.49% and energy up 1.92%.
Clearly outperforming technology, which closed down 1.08%. This session's leadership was entirely defensive and commodity-linked.
Indeed. The index performance data reflects this narrow, value-driven leadership. The Dow Jones Industrials advanced 0.32%, while the Nasdaq 100 declined 0.45%.
Furthermore, the Russell 2000 underperformed significantly, dropping 0.65%.
Which is consistent with the rate-sensitive small-cap complex struggling against a backdrop of elevated long-end yields. Small-cap balance sheets are uniquely vulnerable to prolonged periods of high borrowing costs.
Moving to the desk data on European and Asian equities, we see the same themes permeating global trading. European markets closed before the most acute headline volatility hit during the U.S. afternoon session, leaving indices largely unchanged on the day.
However, looking at the underlying composition, the FTSE 100 outperformed its continental peers, specifically due to its heavy commodity and energy weighting.
Right. In Asia, the Kospi was dominated by fears of a Samsung labor strike, which we will detail later, while the broader focus remains on the structural issues within the Chinese economy.
If equities are defensively rotating due to inflation fears, we need to transition into the bond market impulse to see how that inflation is being priced. The curve dynamics today require precise analysis.
The front end rallied, with the 2-year dropping roughly 2.7 basis points on those brief de-escalation headlines, yet the long end bear steepened.
The 30-year Treasury continues to act as the 800-pound gorilla, closing at 5.126%, up 1.3 basis points on the session. The 10-year, 2-year spread now sits at 53.94 basis points, showing a steepening bias.
On that point, analyst consensus and institutional research are urging the Fed to drop its easing bias at the June meeting. The mechanics of the curve steepening reflect a market that is demanding higher compensation to hold long-duration debt in the face of persistent inflation.
Fed funds futures are already pricing roughly 25 basis points of rate hikes by January 2027.
The bond market is issuing a clear warning regarding persistent inflation risk and fiscal supply concerns. Furthermore, we observed the Fed's overnight reverse repo facility jump to $7.19 billion across 21 counterparties.
Let us pause on that reverse repo figure for a moment. This represents a technical normalization of short-term funding, sending cash back to the Fed as overnight general collateral repo traded down to 3.45%. It acts as a sponge, absorbing excess liquidity from the system.
Understood. But with the 10-year real yield at 2.130%, we are looking at highly restrictive territory. Mechanically, if the 30-year sustains a break above the 5.15% threshold, how rapidly does institutional modeling suggest we see a broad equity valuation reset?
The repricing would likely be immediate and severe. You have to consider the mechanics of a discounted cash flow model. Higher for longer yields fundamentally challenge long-duration assets like technology because those future earnings are discounted at a much higher risk-free rate today, stripping away the justification for extended multiples.
So when the 30-year yield crosses the 5.15% threshold, algorithmic asset allocation models often trigger automatic rebalancing from equities into fixed income.
And this hawkishness is not isolated to the U.S.
Yeah.
Globally, we see the Czech National Bank governor signaling readiness to raise rates if core price risks rise.
Furthermore, institutional research from major dealer desks expects delayed rate cut timelines in emerging markets, with Turkey's funding normalization now pushed out to July and rate cuts delayed to September. The global macro regime is shifting toward a tighter posture.
Moving to the desk data regarding credit, there is a striking calmness in the credit market compared to the volatility observed in equities and rates.
If the macro regime is tightening, one would expect credit spreads to widen aggressively.
Yet the CDX High Yield Index sits comfortably at 314.48 basis points, and investment grade is at 53.72 basis points. High yield ETFs finished marginally positive on the day, with no significant spread widening in the CCC or BAA tranches either.
Indeed. The market is treating the Iran situation as a tail risk with a known ceiling rather than a systemic credit event. Primary market activity was muted, and no major fallen angel or default events were flagged across the major corporate tiers.
Mexican sovereign 5-year credit default swaps even tightened to 94.3 basis points, reflecting broad emerging market credit resilience. The credit market is currently signaling confidence that corporate balance sheets can absorb the current rate structure, at least in the near term.
Correct. On that point, the VIX actually fell 3.3% today to 17.82. This brings us to a critical structural issue. Remind us mechanically why the roll-off of concentrated dealer gamma positioning post-expiry matters for downside supply right now.
Certainly. Prior to the recent options expiry, concentrated gamma positioning effectively anchored the market. When clients buy options, dealers who sell them must hedge their exposure to remain delta neutral.
In a positive gamma environment, this forces dealers to buy dips and sell rips in the underlying index, which artificially suppresses realized volatility.
Post-expiry, a significant portion of those contracts rolled off. The market loses that supportive structure. You can think of it like removing the shock absorbers from a vehicle right before navigating a pothole-filled road.
Right, so every bump, or in this case, every sell order, translates directly to the chassis of the market without being dampened.
Currently, proprietary data shows systematic commodity trading advisor demand is nearly maxed out. They are long $95 billion in global equities, sitting at the 64th percentile, and long $44 billion in U.S. equities at the 79th percentile.
Wait, if systematic demand is essentially operating near its upper bound, does that not mean there is structurally no one left to step in and buy if a geopolitical shock actually materializes tomorrow? So systematic re-risking is effectively exhausted.
Precisely. The dry powder from trend-following algorithms is largely deployed. To quantify that risk, desk flow models project that in a one-month downtape scenario, CTAs would be forced sellers of $121.23 billion globally, with $38.24 billion coming directly out of the U.S. market.
The mechanics of trend following mean that if the market breaks key moving averages, these algorithms switch from being the primary buyers to becoming forced, price-agnostic sellers.
Without systematic buying to absorb those sell orders and without dealer gamma to compress the variance, any technical break lower opens up massive unhindered supply.
This brings us directly to portfolio vulnerabilities and strategy. We're observing a staggering buildup of leverage in the prime books. Detail how gross leverage sits at 318%, a 5-year high.
Right, net leverage reached 78.4%. When you pair a 5-year high in gross leverage with an environment devoid of gamma shock absorbers and maxed out CTA positioning, the fragility of the current rally becomes apparent.
Even more concerning, levered semiconductor assets under management have doubled in just 6 weeks, heavily sponsored by retail.
The sector dynamics here are critical to parse. We have a major earnings report upcoming from a leading AI hardware firm this Wednesday. The forward guidance will be scrutinized not just for revenue, but for supply chain integrity and capacity constraints.
Their CEO recently commented from a conference in Las Vegas regarding Vera CPUs reaching major AI labs and the expectation that the Chinese market will eventually open to U.S. AI chips over time.
We must pair this with the 5.95% drop today in a major memory manufacturer due to a Samsung labor strike. This highlights acute supply chain fragility.
The market initially sold the memory manufacturer on supply chain uncertainty, despite the paradox that a Samsung disruption would likely benefit competitors' pricing power. This suggests an environment where investors are adopting a shoot first, ask questions later approach to any hint of disruption in the semiconductor space.
Indeed, there is a critical divergence in institutional positioning occurring beneath the surface. Major dealer desks report that hedge funds have recently made semiconductors the most net sold industry group over the past month.
Simultaneously, they are rotating into software and services longs. This is a notable reversal of year-to-date trends.
You have retail participants piling into the late stages of a momentum trade via levered products, while institutional capital quietly heads for the exits, rotating into software where valuations are arguably less stretched and margins are more defensive.
This reflects a strategic recalibration. Hedge funds are reducing exposure to the crowded long semiconductor trade and seeking relative value in software. It highlights a contrarian consensus risk.
Right, the broader market is positioned for an unencumbered AI capital expenditure boom, assuming uninterrupted growth and unlimited liquidity to fund these capex cycles.
Yet the macro data, flatter curves, rising long yields, and intervention-level currency weakness, with USD/JPY near 159, points strictly to late cycle tightening.
You cannot sustain infinite expansion multiples in an environment where the risk-free rate is commanding a premium above 5%.
Furthermore, we must factor in corporate demand, which is acting as a major counterweight to these structural risks. Buyback desk activity remains elevated, finishing last week at 1.2 times the 2025 year-to-date average daily volume.
We estimate 96% of S&P 500 corporates are currently in their open market repurchase window. This seasonal window provides companies with the greatest flexibility to deploy capital without regulatory blackout constraints.
And we saw 40 new programs authorized this week for $24 billion. This corporate bid is a structural pillar supporting the market against the deteriorating macro backdrop we just outlined.
Moving to the desk data on foreign exchange, the dynamics confirm our cautious read on the macro regime. The U.S. dollar index slipped 0.32% to 98.968, consistent with the Iran de-escalation narrative reducing immediate safe haven dollar demand.
The euro was marginally firmer, and the British pound remained stable near recent highs.
The stability of the Chinese offshore yuan at 6.7989 is also notable. It suggests no immediate intervention concern from the People's Bank of China, despite the geopolitical backdrop and the severely weak domestic economic data we discussed earlier.
Meanwhile, the Australian dollar saw modest outperformance, supported by its linkage to energy commodities. Before we close, consider this structural tension. With Japanese authorities watching the 160 level on USD/JPY closely, and U.S. 30-year yields pushing toward 5.15%, an intervention by the Bank of Japan could trigger a liquidation of U.S. Treasuries, forcing the Fed's hand regardless of domestic data. It is a cross-border feedback loop that warrants your immediate attention.
Exactly. Let's briefly recap today's essential takeaways. First, the stark divergence between a geopolitical risk premium driving oil higher and the macro reality of severe Chinese data misses driving industrial metals lower.
Second, the rates breakout, characterized by the 30-year Treasury yield closing at 5.126% and real yields remaining highly restrictive.
And third, the dangerous combination of a 99th percentile risk appetite reading against maxed-out systematic CTA positioning and a 5-year high in gross leverage.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color and cross-asset analysis.